I want to consider one sum on partnership accounts. The sum is very simple. Calculation of interest on drawing is a point of consideration. Look at the sum. A partner has withdrawn rupees 240 every month. That too at the beginning of the month. If interest on drawing is to be charged at 5% per annum, calculate interest on drawings. Amount is drawn 240. That too at the beginning of every month. We are required to calculate interest on drawings at the rate of 5%. Now, look at the calculation part and the explanation part. First of all, I am going to solve the sum by product method. Here we have presumed that calendar year is the accounting year. In case of product method, the amount drawn is multiplied with the period for which interest is to be charged. So we get a product of amount and the period. Now for next drawing also, amount drawn multiplied by period for interest. Then third withdrawal, amount multiplied by period for which interest is to be calculated. So whatever the number of drawings are made, all those drawings are multiplied with the period for which interest need to be calculated. Now the product of these all drawings will be total, and on this total product we will calculate interest on the basis of unit of period which has been multiplied. Now see, here look at the calculation part. Amount drawn at the beginning of each month, calendar year is my year. So amount drawn on 1st of January, 240. From 1st of January till the end of the year, interest on drawings need be calculated. So from 1st of January to 31st of December, from 1st of January to 31st of December, number of months are 12, amount drawn is 240, 240 multiplied by 12, 2880 is the product. Now next amount drawn is 1st of February, amount drawn is 240, interest calculated from 1st of February to 31st of December, so 11 months. The product of 240 and 11 is 2640, on which interest gets calculated on a unit of period, that is one month. So otherwise, if I want to explain the product method in a different way, 240 rupees interest for 11 months is equivalent to 12640 rupees interest for 1 month. Same way, 240 rupees interest for 12 months at any rate of interest is equal to 2880 rupees interest for 1 month. This is known as equivalent product for the interest. Next amount drawn on 1st of Bar 240. From 1st of Bar to 31st of December, number of months are 10. So 240 rupees on which you are required to calculate interest for 10 months. Instead of calculating interest for 10 months, you can calculate and have the same answer if you calculate interest on 2400 for 1 month. This is the gist of product method. Next amount drawn is 1st of April. Amount drawn is 240. Number of months for which the interest gets calculated is 9 months. From 1st April to 31st of December, 9 months. So 240 rupees interest for 9 months is always equal to 2160 rupees interest for 1 month. That is known as product equivalence for the interest constant amount. On 1st of May, 240 rupees are drawn. On 240 rupees, interest is calculated from 1st of May to 31st of December. Number of months are 8. If you calculate interest for 8 months on 240, will be equal to 1 month's interest on 1920. 1 month's interest for 1920. So what has been equated? 12 months interest calculation is equated to 1 month. 11 months interest calculation is equated for 1 month. 10 months interest calculation is equated for 1 month. 8 months interest calculation is equated for 1 month. So different period interest calculations are equated to 1 month interest calculation. That is the gist of it. Next, on 1st of June, 240 rupees are drawn. You have to calculate interest from 1st June to 31st of December, 7 months. So instead of calculating interest for 7 months on 240, you can have the same answer if you calculate 1 month interest on 1680. This is the gist of product method. Next, July, 240 rupees are drawn on 1st of July. Interest will be calculated for 6 months. 6 months interest on 240 is equivalent to 1 month interest on 1440. May be 5% rate, may be 6% rate, may be 8% rate. Interest rate may differ, but the product is same. On 1st of August, interest gets calculated for 5 months. 1st August to 31st of December, 5 months. 240 into 5 months, 1200. So 5 months interest on 240 is equivalent to 1 month's interest on 1200. Similarly, 4 months interest on 240 is equivalent to 1 month's interest on 960. Similarly, 3 months interest on 240 is equivalent to 1 month interest on 720. Similarly, 2 months interest on 240 is equivalent to 1 month interest on 240. And last withdrawal is 240, on which 1 month interest is equal to 1 month interest. This is how product has been worked out. This product on which interest need be calculated for 1 month. So if I make a total of this product, 18,720. So if I want to calculate interest at the rate of 5%, look at it. 100 rupees interest for 12 months, 5 rupees. How much for 18,720 for 1 month? So if you calculate interest by this method, interest is 78 rupees. Here I have demonstrated the product method for calculating interest on drawings. This method is very useful when the amount drawn at the beginning of every month is different. First month 200, third month 900, 6 months 700. If the withdrawals are in this fashion, you have to solve the sum by product method, and that's why I wanted to give you the idea of product method. I have solved the sum in this method. I have solved the sum by this method. Now I will give you a shortcut for that. So this method is applicable. Product method is applicable even if the unequal amount are drawn. Amount drawn is unequal. At unequal intervals. For product method, you can apply it if the amount is drawn at the beginning of first month, then the amount is drawn in the middle of third month, when the amount is drawn at the end of 6th month. In this way, the time period intervals are also uneven till the end of the year. Then also you can apply the product method. So that's why this product method is the basic method for calculating interest on drawings. Now, this is the basic method that I wanted to explain. Now I want to give you a shortcut. In this shortcut, they say that method 2, formula for interest on drawings. Look at the formula. Interest on drawings is equal to fixed amount drawn per month. What is the fixed amount drawn per month? 240 rupees. On which you are required to calculate interest for 78 months. So here the number of months 78. So interest is calculated for 78 months. For the fixed amount drawn 240. So 240 into 78 divided by 12 into 5%. You will get the same answer, 78. This shortcut method can be applied if the even amounts are drawn. and that too at the beginning of every month. So this method, shortcut method, is applicable with restrictions. The amount drawn every month should be same. Amount drawn either at the beginning of every month, like that. So equal interval, equal amount. Then you can apply the shortcut method. Now look at the third method. Interest on drawings is equal to total amount drawn in the year. What is the total amount drawn in the year? 2880. So now the interest will be calculated on the amount of 2880 into, look at it, the maximum period 12 months plus minimum period 1 month divided by 2 upon 12 into interest rate. So total amount drawn is 2880. If you work it out, that will work out to be 6.5. 12 plus 1, 13 divided by 6.5 months into 5%. Once again, you will come to the same answer, 78. Notice that product method is the basic method which can be applied to all situations. The second method and third method can be applied only in specific situations wherein amount drawn is equal and the amount drawn at equal time intervals. But the answer that you get under all the three methods will be same. So this is how I wanted to explain the concept of interest on drawings. I think you must have followed. Thanks to all of you.